Canada is making a move that could reshape its economy for decades. For generations, Canada has relied heavily on one customer above almost all others, the United States. American consumers buy Canadian oil. American factories depend on Canadian minerals, metals, electricity, and components. American farmers buy Canadian fertilizer. American companies rely on Canadian supply chains, and Canadian businesses in turn depend on access to the enormous American market. It is one of the deepest economic relationships in the world. But now that relationship is under pressure: tariffs, trade disputes, political uncertainty, and the growing possibility that Canada can no longer assume the American market will always remain as open and predictable as it once was. So Canada is beginning to build something different. Not a complete replacement for the United States. That would be unrealistic. Instead, Canada is trying to build options, more customers, more trade routes, more ports, more energy markets, more investment partners, more international agreements. And at the center of this strategy is a number that sounds almost unbelievable: $100 billion. But there is an important clarification. Canada has not signed a single $100 billion trade agreement that suddenly breaks its dependence on the United States. The $100 billion figure is connected to a major expansion planned for the Port of Vancouver. The proposed Roberts Bank Terminal 2 project could unlock more than $100 billion in new trade capacity every year. The Canadian government says the project could contribute more than $3 billion annually to Canada's GDP and support more than 17,000 ongoing jobs across the supply chain. That is a massive number, and it tells us something important about where Canada believes its economic future is heading: west, across the Pacific, toward Asia, toward global markets, and away from the idea that almost everything Canada produces has to move south into the United States. The Port of Vancouver already plays an enormous role in Canada's international trade. Government figures show that the port handles about $1 in every $3 of Canadian goods trade outside North America. It connects Canada to as many as 170 countries. And in 2025, the port handled a record 170.4 million metric tons of cargo. But Ottawa believes the port needs much more capacity. Why? Because Canada wants to double its non-U.S. exports over the next decade, and doubling exports means very little if the country does not have the infrastructure to physically move those exports. You can sign trade agreements, you can negotiate tariffs, you can open foreign markets. But if ships are waiting at ports, rail lines are congested, and terminals are operating at capacity, the opportunity disappears. That is why this infrastructure strategy may be more important than any single trade agreement. Canada is trying to build the physical infrastructure of diversification, and the timing could hardly be more important, because Washington and Ottawa are currently locked in another major trade dispute. As of August 8th, Canada and the United States are still negotiating over U.S. tariffs scheduled to take effect on August 19th. Reuters reported on August 7th that Canadian and American officials were discussing a possible agreement that could prevent those new tariffs. Canada is considering concessions involving automobiles, dairy quotas, and American alcohol products. In exchange, Canada is seeking relief from some U.S. tariffs, including those affecting Canadian steel and aluminum. The negotiations are continuing, but there is no guarantee that a deal will be reached. And that uncertainty is exactly why Canada's diversification strategy matters, because Canada has learned an uncomfortable lesson. Even if two countries have an incredibly close economic relationship, that relationship can still become vulnerable to political decisions. One administration can change tariff policy. One election can change priorities. One executive order can affect billions of dollars in trade. And when one country is overwhelmingly dependent on another country's market, it has fewer options when things go wrong. Canada's response is increasingly clear: build more options. And those options are being developed around the world. One of the most important is India. Canada and India have spent years dealing with political and diplomatic tensions, but the economic relationship is now being rebuilt. Canada says it wants to double two-way merchandise trade with India to $70 billion annually by 2030. That is an enormous target, especially when you consider that two-way merchandise trade between Canada and India was only about $13.6 billion in 2025. Canadian exports to India were approximately $3.9 billion. Imports from India were approximately $9.7 billion. So getting to $70 billion would require a dramatic expansion. But that is precisely the point. Canada is looking for markets where its exports can grow. India is one of the largest economies in the world. Its population is enormous. Its energy needs are rising. Its industrial base is expanding. And its demand for food, energy, and raw materials continues to grow. Canada has many of those resources: agricultural products, minerals, energy, uranium, wood products, and advanced technology. So the potential relationship is much bigger than a simple trade agreement. It is about connecting Canadian resources to one of the world's fastest-growing major economies, and the two countries are working toward a comprehensive economic partnership agreement. Canada says it expects negotiations to conclude by the end of 2026. If successful, that agreement could create a much broader framework for Canadian companies entering the Indian market. But Canada is not stopping in India. Another major piece of the diversification strategy is Europe, and energy is at the center of it. For decades, Canadian natural gas exports were overwhelmingly dependent on the United States. That made sense. The United States was close, pipeline infrastructure already existed, and the American market was enormous. But there was a problem. Canada had very limited access to overseas LNG markets. That is beginning to change. In May 2026, Canada announced its first European LNG deal. Germany's SFE agreed to purchase 1 million tons per year of Canadian LNG for up to 20 years. Deliveries are expected to begin in the early 2030s. Then Canada announced an even larger agreement. On July 29th, the Canadian government announced a binding agreement between KSI Lissim's LNG and Germany's Uniper. Under the deal, Uniper will purchase 2 million tons per year of Canadian LNG for up to 20 years. First deliveries are expected in 2032. That is not a short-term transaction. It is a long-term commitment, and it changes Canada's energy map. The Canadian government says these contracts could help increase the share of Canadian natural gas exports going to non-U.S. markets from less than 0.01% in 2024 to an estimated 55% by the early to mid-2030. That would be a dramatic transformation. For decades, the United States was almost the only destination. Now Canada is building a second major customer base in Europe. And if additional Asian buyers emerge, Canada could eventually have three major directions for its energy exports: south, west, and across the Atlantic. That is diversification in practice. But LNG is only part of the story. Canada is also trying to build a global critical minerals network. Why? Because the global economy is changing. Electric vehicles require batteries. Batteries require minerals, renewable energy requires minerals, semiconductors require specialized materials, defense systems require secure mineral supply chains. And governments around the world are increasingly concerned about relying on a small number of countries for strategic resources. Canada has an enormous advantage here. It possesses many of the minerals the world needs, but possessing resources is not enough. Canada has to extract them, process them, transport them, and sell them. That is why trade diversification and infrastructure investment are connected. A new mine in northern Canada means very little if the minerals cannot reach a port. A port means very little if rail infrastructure cannot reach it. A trade agreement means very little if Canadian companies cannot reliably deliver their products. So Canada's strategy is becoming increasingly integrated. Build the mine, build the railway, build the port, build the processing facility, sign the trade agreement, find the customer, and then repeat the process. That is how a country changes its economic structure, not overnight, but piece by piece. And Canada is now adding another market to that strategy, the United Arab Emirates. In July, Canada and the UAE concluded negotiations toward a comprehensive economic partnership agreement. The UAE is already Canada's largest export market in the Middle East. In 2025, Canada-UAE merchandise trade reached approximately $3.5 billion. Canadian exports to the UAE increased nearly 10% year over year. The agreement is designed to reduce trade barriers and create new opportunities for businesses and investors. And once again, the number is not large enough to replace the United States. But it does not need to be. The objective is to create another customer, another investor, another route, another relationship. And that is becoming the central idea behind Canada's economic strategy, not replacing America overnight, reducing the risk of depending on America too much. The same principle applies to Ecuador. On July 24th, Canada and Ecuador signed a free trade agreement. The two countries traded roughly $2 billion in goods in 2025. That is tiny compared with Canada's trade with the United States, but that is exactly the point. Canada does not need to find another America. It needs to build a network of markets that together reduce its dependence on America. Think of it this way. If one customer represents most of your business, losing that customer can be devastating. But if you have 10 major customers, losing one is painful but manageable. That is the economic strategy Canada is now pursuing, and the numbers show why. Even after all these new agreements and partnerships, the United States remains overwhelmingly. Roughly 7 out of every 10 Canadian export dollars still go to the American market. Canada is therefore not walking away from the United States. It cannot. The border is too close. The economies are too integrated, and millions of jobs depend directly or indirectly on the relationship. Canadian factories rely on American components. American factories rely on Canadian materials. Energy networks cross the border. Railways and highways connect both countries, and supply chains often operate as if the border barely exists. So Canada's goal is not to destroy that relationship. It is to reduce the risk of depending on it too heavily. And that brings us back to the $100 billion Port of Vancouver project. The proposed Roberts Bank Terminal 2 expansion could unlock more than $100 billion in annual trade capacity. The government says the project could contribute more than $3 billion to Canada's economy every year and support more than 17,000 ongoing jobs across the supply chain. But the most important part may be its location. The port faces the Pacific. That means more Canadian goods can move west instead of almost always moving south. More grain, more minerals, more agricultural products, more manufactured goods, more resources, and potentially more energy-related products. The idea is simple. If Canada wants to sell more to Asia, it needs the infrastructure to reach Asia. A trade agreement can open a door. A port allows Canadian businesses to actually walk through it. And Vancouver is not the only piece of the puzzle. Canada is also expanding its energy connections with Europe. For decades, Canadian natural gas exports were overwhelmingly tied to the United States. That is now changing. Germany has agreed to buy Canadian LNG through long-term contracts. One agreement involves SEFE purchasing 1 million tons per year for up to 20 years. Another agreement with Germany's Uniper involves 2 million tons per year for up to 20 years. The significance is bigger than the individual contracts. Canada is creating customers outside the United States for a product that has historically depended heavily on the American market. And if more European and Asian buyers follow, Canadian energy producers will have more options. That means greater resilience. It also gives Canada another source of economic leverage. Now consider critical minerals. The global economy is entering a period where minerals are becoming strategic assets. Lithium, nickel, cobalt, rare earth elements, uranium. These resources are essential for batteries, electric vehicles, clean energy technology, advanced manufacturing, and defense. Canada has many of these resources, but having minerals underground is not enough. Canada needs mines, it needs processing facilities, it needs transportation, it needs ports, and most importantly, it needs customers. That is why Canada is trying to build relationships with countries that want secure supplies. India is one example, Europe is another. Japan and other Asian economies are also important. The Middle East is becoming another destination for Canadian investment and technology. This is all part of the same strategy: more buyers, more routes, more investment, more choices. And there is another important piece: foreign investment. Canada cannot build new mines, ports, railways, and LNG facilities without enormous amounts of capital. The government has set a goal of attracting $1 trillion in investment over 5 years. That is an enormous ambition. But it shows how seriously Ottawa is taking the diversification strategy, because diversification is expensive. A new mine can cost billions, an LNG project can cost tens of billions. Port expansions require huge infrastructure investments, railways need upgrades, processing facilities have to be built. And investors need confidence that these projects will actually reach profitable markets. That creates another challenge. Canada has to move quickly. Permitting delays can slow projects for years. Environmental requirements have to be met. Indigenous rights and consultation have to be respected. Provincial and federal governments have to cooperate, and companies need predictable rules. The Roberts Bank Terminal 2 project itself demonstrates how complicated this process can be. The project has been under regulatory review for years. That means Canada's diversification strategy cannot succeed through announcements alone. It needs construction, it needs execution, and it needs results. There is also no guarantee that every new trade agreement will produce massive export growth. A free trade agreement does not automatically create customers. Canadian companies still have to compete. They have to understand foreign markets. They have to meet different regulations. They have to build distribution networks. And they have to offer products that buyers actually want. But the potential is significant. Canadian agriculture is already globally competitive. Canadian energy resources are enormous. The country has critical minerals, it has advanced manufacturing, it has aerospace, it has technology, it has financial and professional services. The challenge is connecting those strengths to more international customers, and that is why Canada's strategy is much bigger than one trade agreement. It is an attempt to redesign the country's economic map. For decades, the map was relatively simple. Canada produced, America bought, Canada imported, and the two economies became deeply integrated. Now Ottawa wants something more complicated. Canada can still sell to America, but it also wants to sell more to Europe, more to India, more to Asia, more to the Middle East, more to Latin America, and more to other global markets. That would not make Canada independent of the United States, but it could make Canada less vulnerable, and that distinction matters, because the current tariff dispute has demonstrated how quickly political decisions can disrupt trade. The August 19th deadline is approaching. Ottawa and Washington are still negotiating. Canada wants tariff relief. The United States wants concessions. And both sides have enormous economic incentives to reach an agreement. But regardless of what happens on August 19th, Canada's diversification push is unlikely to disappear. If the two countries reach a deal, Canada will still want more markets. If negotiations fail, Canada will need those markets even more. Either way, the strategy continues. And this could ultimately change the relationship between Canada and the United States, not by ending it, but by changing the balance. Imagine a Canada that can sell its natural gas to America, Europe, and Asia, a Canada that can sell uranium to India, a Canada that can supply critical minerals to several industrial economies, a Canada that can send more agricultural products across the Pacific, a Canada with major investment relationships in Europe and the Middle East. That Canada would still need America, but it would have alternatives, and alternatives create bargaining power. That may be the real meaning behind the $100 billion figure. It is not a giant check. It is not one massive trade agreement. It is infrastructure. It is capacity. It is the ability to reach customers that Canada could not easily reach before. And that could become one of the most important economic investments Canada has made in decades. But there is a final question. Can Canada move fast enough? The world is changing quickly. Countries are competing for investment. Companies are restructuring supply chains. Energy markets are shifting. Critical minerals are becoming increasingly valuable. And governments are using tariffs and trade restrictions more aggressively. Canada has an opportunity. But opportunities do not last forever. If Canada builds the infrastructure, secures the investment, and signs the agreements, it can become a much stronger global trading power. If projects are delayed and investment fails to materialize, the country could remain heavily dependent on the American market. So the next few years will be critical. The Port of Vancouver expansion, the LNG projects, the India relationship, the UAE partnership, critical mineral development, and the broader push to increase non-U.S. exports. All of these pieces will determine whether Canada's strategy succeeds, and the goal is not to choose between America and the rest of the world, it is to have both. America will remain Canada's biggest trading partner, but Canada wants the rest of the world to become much more important. Because the strongest position in a trade negotiation is not having zero dependence. That is almost impossible. The strongest position is having alternatives, and Canada is now building those alternatives. One port, one contract, one trade agreement, one investment project at a time. So the story behind the $100 billion headline is not that Canada has suddenly escaped the United States. It hasn't. The real story is that Canada is trying to make sure it never has to depend on one market quite so heavily again. And if that strategy succeeds, Canada's economy could look very different by the middle of the next decade. More global, more diversified, and, perhaps most importantly, more difficult to pressure from any single direction. Canada is not closing the American door. It is simply building more doors.